Everyone, welcome to Officer 24/7. My name is Nehar Kavalia Bhatnagar and I'm with you with the area of ABFM. What have we started with? Let's have a look at it. Okay, so today we are starting with the module B. Acha, everyone, this is actually not the first class of module B. Till now, we are done with a good number of questions, topics related to module B. What are we done with? Regarding module B, we are till now done with the topic of okay, we finished the sources of finance, right? And then we did the leverages, and then I started with capital investment decisions. And I told you that this is also a very, very important chapter of the module B. Not only because module B is very important, but because of one specific reason that this becomes the basis for the next chapter along with many chapters of module C. So probably doing just one chapter is going to help you to understand, to decode, and to do properly the remaining, I think, at least 3 to 4 chapters, right? So it's way better that we learn it in this particular chapter itself. How does it come normally? It is a numerical based chapter where you have to understand the numerical. Only then you will be able to understand the theoretical portion of it. So that's an important point regarding this particular uh, topic. Okay, now let's move on and okay, I hope I'm audible clearly, everyone. Done then. Let's begin with it and talk about it further. In this area, we talked about module B, capital investment decisions, that we started in the last class. First of all, please share this session among your peers because it is very, very important to receive feedback from you regarding the classes. If you like this particular session, then please like it as well. Along with it, if you haven't subscribed to our channel yet, then please subscribe to our channel and share this session among your peers as well so that it reaches out to all those people who are preparing for CAIIB and looking forward towards ABFM questions. Okay, everyone, let's continue. Uh, Here comes the first question. A capital budgeting decision does not require the computation of cost of capital for decision making purposes is the question which does not require anything related to the cost of capital, that is NPV or net present value method, or international rate of return method, or modified internal rate of return method, and the last payback period method. Okay, uh normally, okay, the answer is payback period. Let me come back and tell you why. The first three methods are done on discounted basis, while the last one, payback period, it is done on what basis? Payback period is done on the basis of if I spend 10 years, if I spend, nay, let's just talk about if I have overall I spent 10 lakh rupees. In how much time I am able to recover my 10 lakh? That is what we call payback period. Okay? Done, everyone? So in this case, what's going to be the answer? The answer is payback period. Payback period is basically a period which defines Let me give an example of payback period, a practical question, so that you can actually understand the topic of payback period. Uh, my initial investment was of rupees 20,000. Now, these are my years, everyone. Year 1, 2, 3, 4, and 5. Cash inflows. Initial outflow or initial investment is basically 20,000. Now, cash inflow that I'm receiving. In the first year, I received 2,000. Second year, 2,000. Third year, 2,000. And it goes on and on. And someone asks me, what is the payback period? What's the payback period for us, everyone? In how much time are we recovering this amount? Payback period can be said as it is 20,000 rupees is my initial investment. You divide your initial investment by your per annum inflows. If I want to recover 20,000 all in all, and every year I am receiving 2,000 rupees, in how much time can I recover it all together? It would be 20,000 divided by 2,000. Technically, it's going to be 10 years. If I made an investment of 20,000 years, 20,000 rupees, then I have to wait for at least 10 years to recover this particular amount, है ना? This particular concept is called payback period. This is a question where you have uniform cash inflows. Good question. These kind of questions can be definitely asked in the examination. They can convert this kind of concept into a question, or they can actually ask you an MCQ based upon this area. Okay? So in this case, the correct answer is 2,000 overall. If 2,000 rupees is received every year, then technically the amount is going to be 20,000 recovered in overall 10 years. Okay, now this was a method which does not use or relate to the area of adjustment of the money as per the present value. The present value of the money definitely changes now. If you remove the portion of interest from the futuristic value, what you get is your present value. If I say after 5 years I'll receive 100 rupees, probably now what I've invested might be just 70 or 80 rupees per month, and after 20 years, 10 years, what I'm going to receive is this money being invested in the markets, and then markets converting it into money and giving us our promised share. That's how this entire thing works. So this is about the entire scenario where they talk about the capital investment decisions. है ना? IRR method would in favor project proposals which have अच्छा IRR NPV, these are both present value based techniques. For these techniques to truly be clear to you, you need your own calculator, and at the same time you need the book as well, because in the Macmillan book they give a lot of questions, and if you don't have the book, then don't worry, I am sharing a lot of questions in the classes itself so that you can review it afterwards as well. So please feel free to contact regarding the PDFs of these classes. Along with this, let's talk about the particular question related to internal rate of return. Under internal rate of return, now you don't know what is that particular rate of return that you are technically getting. Overall now, the methodology was developed way before. We even studied about it. It had been working since then. Internal rate of return is at that particular return where your NPV is equal to 0. Everybody got the idea? In terms of internal rate of return, what's happening there? Internal rate of return is the rate at which the particular person wants their interest on. While when we talk about the company, this might turn out to be a compulsory payment when payment is khair वैसे भी it is required, but any kind of delay can actually add more to the finance cost now. If I talk about uh, anybody who's studying far off uh, from their parents, how are they studying, everyone? If the students are studying there, they are putting money on their infrastructure, they are for the particular stay back in terms of their voluntary and everything, you know. So just like that, when a father is taking decisions for the kid, it is always worried about its presence. Same thing happens with humans. When we talk about the working of IRR, na, IRR talks about your NPV, whether you, if you invest 100 rupees, are you getting 100 rupees back or not? If you are not, then it is not worth it. Or when the particular returns of the business is not as per the requirement. Done. So in this case, when we talk about IRR, heavy cash inflows in the early stages and then early distributed cash inflows throughout the year, or heavy cash inflows at the later stages. Which particular thing will be there in terms of the favor, everyone? When we talk about IRR, having evenly distributed cash inflows throughout the year. However, cash inflows at the later stages of the project are basically kept with the uh, customers there. Now, in this case, it goes like this, but it is better when we are talking about IRR. IRR is based upon NPV. The moment your NPV is zero, then your IRR is at its highest. So, higher the cash inflows in the early stages of the project, normally people really don't feel like working on it again on a very short notice, first of all, and that too in a very limited scenario, na? Because every organization has to grow further. Acha, we were talking about IRR, na? IRR. Okay, going back to the area of IRR, heavily cash inflows in the early stages of the project. The reason is, in the early stages of the project, your value of the inflow is normally less, so whatever you do during that period is fine, but when the organization is growing further now, then it needs to think a lot. Done, everyone? Acha, let's do the question. While evaluating capital investment decisions, this is related to the area of proposals towards the area of time value of money, and then is used in which of the following techniques when we talk about this: payback period and accounting rate of return. Both the first and the second, these are based upon what's going to be the answer in this case? A capital investment decision where time value of money. What will be the answer, everyone? The answer in this case is going to be NPV. Under NPV, you find the time value of money, and based upon the time value of money, you calculate the portion there. Depreciation is included in the following. First is accounting rate of return, then is NPV, then is internal rate of return, or none of the above. Do you know depreciation is a non-cash expense? Depreciation is a non-cash expense. And when it is a non-cash expense, then obviously the NPV method or IRR method is not going to be worried about it. The method which is actually worried about it is accounting rate of return. In accounting rate of return, they have to prepare the P&L as well, and they have to prepare the balance sheet along with it. So in this case, it becomes a little challenging, an accounting rate of return records it in the books of accounts, and through the area of non-discounted techniques, accounting rate of return is basically based upon our profits and losses that you are making in the business. Okay, so this is actually a good technique, but this technique has only one problem. It is not considering time value of money. It is just considering the value which is spent. Maybe it is spent in the next 5 years, 4 years, 3 years, whatever time it will take. Okay, acha, everyone, here comes the next question. This is actually a practical question to try on. So let's talk about this. This is a project. The project of initial investment is of rupees 50,000. Then is expected to generate 20,000 in the first year. Then we have 25,000 in the next year. Then we have 30,000 in the next year. And then we have 1.1 to 1 to 12%. It is going to be 1 plus 12%. So in this case, when we are dividing now, it is going to be 1 divided by 1 plus 12%. In the first case, it is just going to be 1, then this is 1 plus 12% raised to power 2, and this is 1 by 1 plus 12% raised to power 3. Everybody got the idea? 1, 2 and 3. In this case, what are you going to do? Multiply it. When you multiply it, what will you get? 20,000 into 1 divided by 1 plus 12%. In this case, how do you calculate it? You can do this divided by 1, then click on divided by, then divide by 1.12%. Okay? Or you can directly just do that as 1 divided by 1.12. Then calculate the values. When you divide by 1 divided by 1.12, you will get the first value that should be there with this 20,000. Then let's just calculate it together itself. Everybody, please pick up your calculators. One divided by 1.12, you get the first as 0.892. This is 20,000 into 0.892. Then after you have got this particular figure of 0.892 now, then do not further do the procedure of having a square first and then moving on. Just take out the square of both these points. So this will give you after you have 0.892 for multiplication, in the next case it's going to be 1.7857, and then click on equal to again. Okay, it is 1 divided by 1.12. One divided by 1.12. In the first year we get 0.892, second year we get 0.797. I had a calculation mistake. Now this is equal to 0.797. And let's take up the last value as well. That is 0.711. Now this is 30,000 into 0.711. So this is the point where you are going to take up the time value of each and every year. What is it that the particular discounting factor they have to use? We have already decided. After that, it is the course of the organizational heads which are going to review it. So 20,000 divided by 1.12 is 17,857. Then 2 years, it is 19,538. When we talk about 3 years, it's going to be 21,647. In terms of the working, this is it, I believe. That's all we need to know about this area. You know, what are they doing? Capital investment decisions. They just did one thing, that is 1 divided by. Done, everyone? Done, everyone? So this is it. Now comes the next question. What are the different financial decisions which are made by a business? Pricing decision, product or service, or capital budgeting decisions? What would be the answer, everyone? In the next case, what are the different types of different financial positions like what would be the answer, everyone? What would be the answer, everyone? Financial decisions. Financial decisions are all about money, na? So this is pricing is related to the money. So then it would be then pricing or service decisions. When we talk about this area, in case we are having a particular transaction and we want to know whether it would be done in future or not. In this case, when at any situation such things happen, what can be done? Then everyone, what would be the answer? The different types of financial decisions, all of these are financial decisions. None of them relates to the normal life of a person, and this is not even personal. This is something which they call your professional. You know, this is another point that is there in terms of this specific chapter. The answer in this case is D. That means both, rather, or when you're talking about the pricing decisions, it is included in it. When we talk about the value of the product that we are selling, included in it, and any capital budgeting decisions. Matlab, if the company has taken decision to get something for the organization, then that is it. We'll be talking about that particular part itself. है ना? Done. So in this case, in actual, the answer would be what? It is going to be all of these together. Chaliye, that's it for the day, everyone. Let's end this session here itself. But before I end my session, please don't forget to enroll yourself in our courses. How do you enroll yourself? You need to open up our course, that is, you have to open up our website, that is Adda 247. If you go through the app, it is way better because you get further discounts. Let me take you to our website where you can do the specific work. Okay. So now look at this, everyone. I have opened up www.under247.com. Go on to the area of JIB and CIB. Go on to the area of June 2024. Right now double validity and all these things are going on. Just all these batches have already been out. That means our Shapath batch is out and our Sankalp batch was previously there. Now resolution batch is also going on. And what you need to do is, if we talk about the ABFM, then okay, everyone, let's go on to this area. As you can see, if you want to purchase this particular course, then you need to use the code Y541, because as soon as you apply the code Y541 now, then you get 80% discount. which is currently the lowest. And if you're planning for all the four subjects, or you're just planning for only accounts or any other subject, then what you can do is you can check it out on our website and our app for further details. Then the course would cost you 1889.79. So if you're interested, then enroll yourself in the ABFM as early as possible. And